Today, me and Mike are going to speak to analyzing a specific stock and actually going in and making your own analysis, since we're not financial advisors, to if you should buy a stock or not. What is the most basic things that you should know? Because when you go on, for example, Yahoo Finance, the website all the data we're going to use today is from, if you're new and reading these things, you're like, what? What's going on? I have no clue what any of this means. P, what's that? PG, what? If you got like, if you took accounting in school, some of like the gross profit and stuff like that makes sense. But that if you took accounting, if you didn't, you're completely screwed. So, Mike, what is the most simple and important terms that a person should learn?
The most important terms a person should learn when it comes to thinking about investing in stocks are price. That's what you're going to pay. You should learn the term shares. Shares simply means a portion of a company. So a company that's selling shares of stock means you own a certain amount of that company. So never get confused with what a share and a price mean, because there's a lot of confusion out there. Another term that you need to understand is cash flow. That is how much cash is flowing into that company and how much cash is flowing back out again. In other words, what are they receiving for the item that they sell, and how much are they spending to keep producing that item? So these are the basic terms you need to understand. Following on that, a secondary term that's super important to understand is debt. There's two debts you care about. One is your own. If you have credit card debt, if you have any other debt that's a high interest rate, pay it off. Get rid of it as fast as you can before you start investing. The second application of debt you need to think about is, what does that company owe? Are they making enough money to pay their debts? Because if not, they're not going to be in business very long. So those are some basic terms, Moss.
So, with those basic terms, we're gonna go into some a bit more complicated ones. Since I did a bit of analysis, I'll get the document up here on the screen. And if you want to look at it yourself, I'm gonna have it down below. You can go into Google Sheets and look at it. But basically, I thought to myself, what is an industry I know something about? And I was like, cars. And then I went in to actually find the different car conglomerates, because most car brands are owned by somebody else. So you're going to buy the shares of the big companies. Let me see if I can get it up without any hassle. Apparently, I can't. Here. So what we're looking at here is a bunch of different car manufacturers and their PE ratio, which is basically how much they earn or how much you have to pay for them earning a single dollar. And
Yeah, it's a ratio. It takes the price per one share of stock and divides that by the earnings on that share. So yes, it's how much are you paying for the money they're bringing in the front door. Now, a non-seasoned investor, someone who's fairly new to this, might think that if a company makes $1 in earnings, you're paying $1 for that. But that's not true. You're paying much, much more, because people are taking a calculated probability that the company will be worth more in the future. So the price of a share of stock is really a bet. It's a calculated bet. It's not a gambling bet. It's a calculated bet on, you think that that earnings number is going to go up in the future. So you're willing to pay more for it today because it's going to be worth more in the future. Sort of like if you told your buddy, hey, loan me $20 a year from now, I'll give you $30 back. Your buddy will say, that's a 50% increase in a year. Sure, I'll do that. So it's that kind of calculated risk. Then you have the price to earnings growth ratio there. That is, again, it's a calculated probability of how likely is it that the price I pay for this stock right now today is going to be worth more in the future. And earnings growth then measures how fast are those earnings going to grow, or are they going to go down? Um, because for every sale of a share of stock, someone's selling it and someone's buying it. So there are people who want to see things go down. There are people who make their money when things go down, people who make their money when things go up. So the earnings growth ratio, the second thing on second line on that chart, it's looking at, is the earnings growth potential going to go down or up? Meaning, is the company going to make more money or less money? And you can think about, oh, you can think about companies that you've heard of in wherever you're living, whatever country you're in. You can think of companies that in the past few years have been doing not as well as they did before. That would be an example of earnings going down. Which, if that's the outcome you're looking for, you can make money doing that as well. And what's your next one? Is that debt ratio?
Yeah.
Yeah. So that's the ratio of how much money does the company owe. So again, going back to our buddy that asked us to borrow $20 and promised us 30 back in a year. And we, knowing this buddy, might say, well, we know what he's doing with the money and we know where he's going to apply it. And we have confidence he'll be able to pay that promise. But how much does he owe? So if he says he wants to borrow 20 from us, how many other people is he borrowing money from? And so that has to enter into our calculation of how much we think we're going to really get back. Are we really going to get $30 out of him? Or does he owe so much money to everybody and their grandma that we're going to get like $4? So we got to think about that. And that's what that ratio helps us to determine. And then your gross
So
profit.
yeah,
Yeah, go
gross
ahead.
profit. I wasn't able to find very many numbers. Just in my quick research, I kind of gave up on it. It's a very important number, I know. But firstly, when it comes to the three things we just spoke about, when it comes to PE, you want that to be low, right?
Yes.
What about PEG, price earnings growth? Is that high or
That
low?
you also want that to be low.
Okay, also low. And then debt ratios you actually want to be high. I just want to clarify that.
You want that to be high if the company's using the money wisely. An example would be, let me try to think of a company everybody knows about. So, um,
Well,
the people
there's
that
10 in front of
Apple
you.
say Apple computers, well, we're doing cars. We'll think about BMW car company. BMW has to sell cars to stay in business. That's their main thing. They also sell motorcycles, but the cars are the main business. However, in order to make those cars, they need to buy raw materials. They need to pay their workers. They have, factories where things are made. They got all kinds of things they have to pay for. If they're leveraging their debt correctly, they're paying debt off faster than they accumulate debt, meaning they're paying it faster than they're borrowing, but they're constantly borrowing, so they don't have to use their own cash. This works as long as you have your sales number is higher than your debt number. So debt ratio, if it's high, can be really good for some types of companies. Other types of companies, like you think about your utilities that supply you with heating in the winter or electricity, you don't want them to owe a lot of money because the amount of money that they can charge for their product, which is the power in your house, that's limited by governments, right? Most places, governments determine how much those people get to charge. So they don't want to have a lot of debt. So debt ratio very much depends on the type of business it is. So going back to our buddy, we'd ask, well, how are you going to pay me $30? He said, well, I'm gonna go out and build this massive office building and I'm gonna create co-working space. We go, dude, have you not heard anything about this 2-year shutdown we had? All those co-working spaces got killed. Which brings us to risk. Always think about the risk of the debt. So
Okay.
yes, in general, if you don't know anything else about an industry, you look for the lower debt because it means the company's not borrowing as much or operating without having to borrow.
Because when I just look at these numbers with my limited knowledge, I want to say this in this specific case, Stellantis seems to be the best option because you get high earnings per share compared to At least some of the others, like Tesla or Ferrari, or even worse, Legal Auto, was like $100 for one. And they can basically pay all of the debt off this year and nearly next year as well. And
Yep.
they are a conglomerate like Volkswagen, Nissan, Toyota, Ford. They are big. It's not one of these
Hmm.
up and coming companies. This is like Fiat, Peugeot, Renault, a bunch of companies. What is your thought on this? I would love to hear you elaborate a little bit more on it.
Well, it's always good to ask more questions as a beginning investor and think about, have you read the Stellantis website? Were there things in there that were confusing, or did you understand what they meant? Then, from reading the website, most of these companies will have a section on the website called Investor Relations section. Go read that. They'll have copies of the presentations that they make. Watch those and start listening. And if you get really bored listening to this stuff, don't buy into that company, because if what they're doing is not interesting to you, it's probably not a good investment for you and your personality. The flip side of that is you don't want to get too excited. If someone's using a lot of good looking spokesmodels and they have all this flash and sizzle and blah, 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 they probably don't have any substance behind them. So look for something kind of in the middle. So, back to our Stellantis example, if you look at that website and you say, oh gosh, this looks really interesting to me, and I understand what the presenter's talking about, then you would go into looking at what's called the prospectus of the stock, which explains all the risk factors, how they're planning to expand the business, and in there you want to look at what's the quality of the earnings. So the two basic questions: what do they sell really? Are they selling a product? Are they selling a service? Are they selling a feeling? These are the three main things. And then, how will they increase those sales? Where's their new market coming from? Some car companies, the new market comes from people replacing the old cars as they wear out because they have brand loyalty and people want to buy the same thing again. Some companies sell on emotion. It's just the feeling that I own this vehicle. So you look at those kinds of things, and then you're investing with a lot of, well, I say a lot of uncertainty at this point for beginner investors, because there's so much you just haven't experienced yet. But these are basic building blocks and things you look at. And I always say, if you cannot read through the annual report, which all companies are required to file this thing once a year, if you can't read through one of those, then you probably shouldn't invest in that particular company because you don't understand the company very well. So it's important to do your research and understand what you're investing in.
So you
Now,
want to go in and like, I guess the investor resources is the last time. Actually, I'll shut this down for now. Is there, when they have this meeting of all the investors come together and they hear what they have planned for the company, right?
yeah, that's a basic thing. So most websites will have the investor relations section and have multiple files you can open. Some will be recordings of live presentations they did. Those are good to listen to. Some will be just strictly documents. Now, I know sometimes people have trouble reading for whatever reason, or it's a foreign language or whatever. You can get most of the idea from those live presentations. So reading through the reports is important, but if you're a person that has a lot of trouble with that, then just stick with the recordings. You'll
Mhm.
get you'll get enough of the idea.
And what to look for in an annual report? Because that's another question.
Annual reports and presentations, you have to remember, are usually written by someone that's very close to the operations of the business. Then they're checked over by lawyers. Then they get out to the public after the sales and marketing people look at it. So by the time it gets to us, it's three steps removed from what the person actually wrote. What you're looking for is the leader of the company taking responsibility for things they messed up. When I read an annual report, if the leader of the company never says anything that he messed up or she messed up, I won't invest because everybody makes mistakes. And if they didn't make any mistakes in a whole year, they're either not telling me the truth or not paying attention to what they're doing. So look for somebody that talks about the good and bad. Um, Stay away from using politics as a guide for yourself. For example, you might see somebody that in their annual letter is saying a lot of political stuff. You might love what they're saying. That's not a reason to invest. It doesn't mean they know what they're doing. So I try to stay away from companies that are overly political for me because I want companies that focus on business. But those are some things you're really looking for. You're also looking for, are they talking a lot about things that have nothing to do with the business that are not political? So are they talking about other stuff outside the company? And you're like, well, how does that help the company? One of the movements we've seen in recent years is this ridiculous DEI thing, which anybody in the business will tell you should be spelled DIE, die. It's how you kill a company. The original idea has been around for thousands of years. It's like you put the best people in the best jobs. You don't worry about what they look like. You don't worry about their ages. None of that matters. It's like, are they good at what they do? Can you train them to be better? And that's who you put in the spots, right? And that's how the most successful companies run. Politicians got their fingers in this pie without really understanding what they were doing. And now it's kind of turned into this thing where it's like, if you're not the right color, right age, right gender, blah, 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 you can't work here. Companies that have embraced that should not invest in because they've lost sight of business. And we've seen that. Walt Disney stock went crashing down as an example. There have been several others that have come crashing down because of the lack of focus. So you have the politics side, which is fine. But if a company's talking about that all the time, you're like, what are they focusing on? And then you have more the social side, this DEI stuff. Again, it's like, what are they really focusing on here? One thing we're predicting at our firm, United Airlines stock is probably going to come crashing down relatively soon. That's our best estimate because of things that the CEO has been saying in public that have nothing to do with flying airplanes. So look for these things and pay attention. What you'd love to see, the best annual reports that most of us have ever seen are written by Warren Buffett for his Berkshire Hathaway group. Go read some of those. They're all up on the Berkshire Hathaway website. Read some of the historical reports and see how he focuses on, this is our core business. This is what we're doing. This is what we did wrong. This is how we're getting better. This is our plan. This is how we're treating our people. This is what we're doing for our community. He talks about all those things related to how do those cohesively work to build a better business and help people at the same time. And, he set the gold standard for writing annual reports. Sadly, this is not taught in most financial companies. It should be required reading.
I think they have enough reading already, mate.
Oh, they do.
I won't put any more on them. I won't. That would be cruel. That would be cruel. It's not like they're, most of them at least, not directly evil people. So I think is that the basics?
That's pretty much the basics. Keep your emotions out of it. That's very hard for most people to do. And keep your politics out of it, which is very hard for most people to do. And as much as you are personally capable, read the annual reports, listen to the recordings, and just get a sense what the company is all about before you decide to invest.
Most definitely. And also join our Telegram group to keep resources to make the investing process easier, at least, since we can't do it for you.
And this brings us to another excellent point. No one should be choosing your investments for you. When you talk about going to a professional advisor to have them pick things for you, the best way to use a professional licensed advisor is simply to understand yourself first. What do you really want to use that money for? And then tell them, find me investments that will get me to this point where I'm trying to go. But don't let somebody just sell you stuff.